Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. There's a lot happening in the world today, from geopolitical tensions rising in the Asian region as China announces very significant and several major military exercises in the region. This is in advance of US Philippines holding, I think, their biggest ever military exercises next week. So there's certainly a lot of military equipment and personnel moving about in that part of the world over the next week. And China's movement is largely in response to the president of Taiwan having a meeting with Senator McCarthy in the United States, which they had pre-warned would create a response, and that's what we're seeing. At the same time, over in Washington, we've seen renewed sanctions on China on different aspects of the Chinese economy related obviously to security issues, but nonetheless sort of very aggressive actions ongoing by the US at the same time that the US administration is saying, Janet Yellen is saying, we don't want to decouple from China, but then the caveat was if security concerns would take first preference over economic concerns. So the risk of decoupling between the US and China is perhaps more real than many of us would like to think, because it would have far-reaching repercussions across the global economy. In data in the USA yesterday, really probably the highlight was a fall in existing home sales by 2.4% on the month. And again, existing home sales, they're really at GFC levels, and people keep sort of acting like there's no crisis. We've got a banking crisis simmering in the background, and if bonds start to fall, yields start to rise again, that could very much come back to the forefront, particularly for small and regional American banks. We've got a growing commercial property crisis in the United States as cities are hollowed out for various reasons, large layoffs in some specific sectors, but also general rise in crime and mass raids by people on various stores. In fact, Walmart and Nike and other stores have actually declared that they are completely leaving several major US cities because they're just being ransacked and broken into all the time. So there are real problems there with the Main Street economy. They might not sound like earth-shattering events, but it is the fact that they're happening in a multitude sort of sporadic way that does dampen people's desire to live in the inner city, which means that commercial property prices are probably headed south along with residential property prices. And this is as the equity market begins to tire after several months of quite a strong rally. And it is as bonds continue really to be heavy, despite many people favoring the prospect of a US Fed pivot. As you know, I don't favor that scenario, and it won't happen. But the fact that there aren't enough buyers of bonds around, even though people think there will be a pivot, suggests that that market is also remains highly vulnerable, regardless of what the Federal Reserve might do, because the sentiment for the Federal Reserve is that they'll have to be cutting rates in the not too distant future, yet bond yields keep moving higher. Overall, on the day, they had a bit of a pullback, but overall bond yields have not responded in the way that people had thought they would to this weakening US economic data, suggesting that some bond holders simply want to exit that market. So that's why there's this general pervading feeling of selling USA, and it's not an anti-USA sentiment. It's the reality of what is happening there. And if you read today's note, I'm also suggesting that as Biden announces most probably running for re-election next week, is pretty much a given, but it will become official. I think that will only cement the prospects of President Trump to again take the seat in the Oval Office. Yes, he was indicted, but his popularity has gone up since. The voter pendulum, away from inflation, away from many people in the USA now openly talking about they're not sure about why the United States is investing so massively in the conflict in Ukraine. There is a counter push against that. So all of these factors and the sort of difficult economic environment, the fact that house prices are falling, None of this is working for President Biden, but is working for President Trump. So Trump, as I forecast previously a couple of months ago and again more recently, I think Trump will win the next US presidential election. In terms of economic data in Asia today, we saw quite a bit of data in Japan. The Japan manufacturing PMI hit so the headlines say 6-month high, but it's really been going just sort of up and down sideways for the last 5 months. That's why a little movement up did register a 6-month high, but it's not a big development by any means for that data series. And also the Bank of Japan is going to want to see a lot more traction, a broad-based traction, sustainable traction for the Japanese economy and higher inflation before it would even think about raising interest rates. And as we saw on the day, inflation in Japan fell to 3.2% today. So talk of BOJ rate hikes were too early. The BOJ won't be hiking interest rates, but I do think the yen is still perhaps a buy as it starts to appear one of the more stable economies, even if it isn't growing quickly, one of the more stable economies amongst the major economies, as both the US and Europe still have particularly heavy headwinds. We saw some German morale data out yesterday, or European morale data, and it was a slight improvement in consumer sentiment yesterday. And though it was a slight improvement, it's still actually at GFC levels. And the same can be said of most of the consumer sentiment indices around the Western economies. In Australia today, we saw the Judo Bank manufacturing PMI continue to decline well into contraction territory. So it does look like manufacturing in Australia is already in recession. We know there's significant problems in the housing sector. I think the prospect for a recession in Australia is growing sharply. I spoke a lot yesterday about the RBA changes. I think it is possible that going forward, the Australian people will not be subjected to the same idiocy of monetary policy that created a roller coaster economy that we've seen over the past decade. So there is hope on that front that interest rate policies, monetary policy going forward will be far more nuanced to what Australian people are really experiencing in their daily lives, work and businesses. So I think that is a positive. It will take a little time to implement, but it is most definitely a positive for the Australian economy. But the Australian economy is still tilting over into the valley of economic activity that was created by the RBA keeping interest rates at record crisis, historic lows for far too long, perhaps a full 12 months too long. And making promises about no rate hikes till 2024, which immediately sucked from the future economic activity, normal economic activity that we would have been experiencing now, was sucked back into the last 1 to 2 years. And that's why there's a bit of a void and a valley now, and also the ongoing burden of significantly higher prices, because although the year-on-year inflation number might be falling, prices are still extremely high and still deliver a hardship to many Australian families. And on top of that, there is the ongoing mortgage stress and the rental crisis. So it's very difficult really to see Australia avoiding a recession at this point, because consumer activity is bound to slow, business activity is bound to slow, and we already have some significant problems, as I said, in the housing sector. So the prospect of an Australian recession is actually growing rather rapidly at this time. Overall then, for equities in the US, we saw them continue to roll over, as I wrote the other day about a slow motion rolling over top. I do think that's what we're seeing in US equities, and we've seen some weakness in Australian equities today as well. So not a go out and invest crazily in markets of any kind at the moment, but it is very much a market rich in opportunity for those who want to play clever defense with their investment portfolios. Thank you very much. I wish you all the best. Clifford Bennett, Chief Economist, ACY Securities.